In this module, we shall learn about non-banking financial institutions, its regulations and role in India. Finance is the essence of modern day business and economy. It is essential in businesses for meeting the working capital needs, for purchasing the assets required to run the business and for other essential purposes. All these requirements are not self-financed, but these are satisfied through the network of financial intermediaries. During the process of economic growth, the activities of saving and investment become extremely diversified and complex, which calls for the need of intermediary between these two necessary activities. Financial intermediaries thus play an important role by borrowing money from the savers and making it available to those who are in need of money. In this way, they serve as a link between borrowers and lenders. These intermediaries facilitate this process by creating liquidity and reducing the risk at low transaction cost. Financial institutions work as intermediaries and can be classified as banking and non-banking ones. The former can be characterized as creators of credit and the latter as mere the purveyors of credit. The banking system in India is comprised of commercial banks and cooperative banks, and the non-banking financial institutions like Life Insurance Corporation (LIC), Small Industry Developmental Bank of India (SIDBI), Unit Trust of India (UTI), and Industrial Development Bank of India (IDBI). NBFIs have a key role in expanding the financial and other tailor-made services for the development of the economy. The regulatory framework for NBFI has undergone many changes over time. NBFI with similar functional area are regulated by a particular regulatory agency like Insurance Regulatory and Development Authority of India (IRDA) regulates India's insurance industry. The terms non-banking financial institutions and non-banking financial companies will be used interchangeably in the discussion as both means the same thing. After studying this module, you shall be able to know the meaning of non-banking financial institutions, learn about their evolution in India, identify the types of NBFIs, evaluate the role of NBFIs in the financial expansion of India, analyze the regulatory framework for NBFIs. Let us now explore in detail the meaning, types, resources, role and regulatory framework for NBFIs in India. First, we will know the meaning of non-banking financial institutions known as NBFIs. NBFIs are those institutions which do not have a full banking license, or they are not executed by a national or international banking regulatory agency. NBFI facilitate the bank-related financial services such as investment, risk pooling, contractual savings, market broking, etc., and also offer other non-banking services. NBFIs are financial intermediaries engaged primarily in the business of accepting the deposits and channelizing the scarce financial resources to the capital formation. NBFCs supplement the role of banking sector in meeting the increasing financial needs of the economy. In India, all NBFIs are under the direct control of RBI. A major difference between NBFCs and banks is that, unlike banks, NBFCs cannot accept the demand deposits, issue the checks to the customers, or insure the deposits through the Deposit Insurance and Credit Guarantee Corporation. NBFIs cover a group of institutions that are extremely heterogeneous in terms of their size, nature of incorporation and regulation, as well as the financial intermediation, which is their basic function. on account of their organizational flexibility, they have the capacity to provide tailor-made service relatively faster than banks and financial institutions. The Reserve Bank of India Amendment Act of 1997 defines the non-banking finance company as a financial institution which is a company, a non-banking institution which is a company and whose principal business includes receiving of deposits under any scheme, arrangement in any other manner or lending in any manner. Other non-banking institutions or class of institutions as the RBI may with the previous approval of the central government specify. The definition excludes financial institutions as well as the institutions which carry on agricultural operations as their principal business. Non-banking finance companies are those that consist mainly of the finance companies which carry on hire purchase finance, housing finance, investment, loan, equipment leasing or mutual benefit financial companies, but do not include insurance companies or stock exchanges or stockbroking companies. As per this definition of RBI Amendment Act, a number of loan and investment companies registered under the Companies Act by the business houses for the purpose of making investments in group of companies are now included as NBFCs. The following heterogeneous group of institutes come under NBFCs: loan companies, investment companies, hire purchase finance companies, lease finance companies, housing finance companies, mutual benefit financial companies, residuary non-banking companies, merchant banks, venture capital funds, credit rating agencies, depositories and custodial services. The Reserve Bank Amendment Act of 1997 gives the classification of NBFCs as follows. First, equipment leasing company, carrying on the activity of leasing of equipment as its principal business. Second, hire purchase finance company, carrying the hire purchase transaction or financing of such transactions. Third, housing finance company. Fourth, investment company, carrying the business of acquisition of securities. Fifth, loan company, financing by making loans and advances. These do not include ELC, HPFC and HFC. Sixth, mutual benefit companies. Seventh, residual non-banking companies. Companies which receive any deposit under any scheme or arrangement in one lump sum or in installment by the way of contributions or subscriptions or by the sale of units or certificates or other instruments or in any other form according to the definition of NBFC. Eighth, miscellaneous non-banking companies. They are concerned with managing, conducting or supervising as a promoter, foreman or the agent of any transaction or arrangement. Examples include chit and kuri, which is different from the type of businesses mentioned. The classification was amended many a times. In a broader sense, NBFIs would include the financial institutions also like insurance companies, Unit Trust of India, development banks like Industrial Credit and Investment Corporation of India Limited, Industrial Finance Corporation of India and Industrial Reconstruction Corporation of India Limited, etc. and the state financial corporations too. Next, we will discuss the evolution of NBFIs in post-independence India. Soon after the independence, rapid industrialization program was launched in India which needed long-term investment in capital assets. All the essential and heavy industries which required huge investments were set up by the government of India in the public sector. Public sector industries borrowed from the foreign agencies on the basis of guarantees extended by GOI. For meeting the financial needs of the specific sectors, public financial institutions were established like the Industrial Developmental Bank of India and the statutory finance corporations. These development banks have long been providing direct financial assistance to large and medium industrial concerns. The financial resources of such corporations are raised by issuing the bonds and debentures and also in the form of deposits they accept from the public. Despite this, the private sector had to rely mostly on the commercial banks whose financial base was not large enough to cater to the financial needs of the big corporates. With the insufficiency of the financial institutions and the services provided by them, companies were set up in the private sector under the Companies Act, whose main business was to do non-banking financial business. To set up a non-banking financial company seemed quite attractive to the business firms and industrial groups because of its profitability with the less investment. Many industrial groups or manufacturing companies set up non-banking financial companies as associate finance companies. In India, the non-banking financial sector has recorded marked growth in the recent years in terms of the number of non-banking financial companies, their deposits and business transacted, etc. With the growing importance of NBFCs, the Banking Laws Act of 1963 was introduced to regulate them. For the regulatory authorities to frame the suitable policy measures, several committees have been appointed from time to time to conduct in-depth study of these institutions and make suitable recommendations for their healthy growth within the given regulatory framework. The regulatory framework for NBFIs will be taken up in another section. Let us now know the types of NBFIs in India. Financial institutions are basically of two types: banking BFIs, that is central bank, commercial banks, cooperative credit societies, cooperative banks and post office saving banks, and non-banking NBFIs, insurance companies, mutual funds, investment companies, pension funds, discount houses, building societies, etc. A major difference between the two is that while banks' liabilities are widely accepted as a means of payment in settling debts, this is generally not the case with NBFIs. Sometimes banks invest their deposits with NBFIs to earn the return on investment. NBFCs are commonly known as finance companies and are corporate bodies which concentrate mainly on lending activities in a well-defined area. The NBFIs operating in India fall in the following broad categories. First, Equipment Leasing Company, known as ECL. It's a company which carries on the business of leasing of equipment or financing of such activity as its principal business. Apart from their net owned funds, the leasing companies raise funds in the form of deposits from other companies, banks and financial institutions. Second, Hire Purchase Finance Company, known as NPFC. It's a company which carries on hire purchase transaction or the financing of such transaction as its principal business. The financial sources of hire purchase company are hire purchase finance companies, retail and wholesale traders, bank and financial institutions, which carries on the financing of acquisition or construction of houses, including the acquisition or development of plots of lands for construction of houses as its principal business. These companies are supervised by the National Housing Bank, which refinances the houses loan by scheduled commercial banks, cooperative banks, housing finance companies and the apex cooperative housing finance societies. Fourth, Investment Company. Investment company means any company which carries on the acquisition of securities as its principal business. Business houses form such type of investment holding companies. They provide finance mainly to the companies associated with these business houses. Fifth, Loan Company, LC. Loan company is a company which carries on as its principal business the provision of finance, whether by making loans or advances or otherwise for any activity other than its own. These exclude ELC, HPFC and HFC. These companies are generally small partnership concerns which obtain funds in the form of deposits from the public and give loans to wholesale and retail traders, small scale industries and self-employed persons. These companies earn the spread rate between the interest rate by collecting the fixed deposit from the public by offering higher rates of interest and giving loans to the others at relatively higher rates of interest. Sixth, Mutual Benefit Finance Company, NBFC, that is Nidhi Company. Nidhi Company is any company which is notified by the central government under section 620A of the Companies Act of 1956. Its main sources of funds come from the share capital, deposits from the members and deposits from the public. Nidhis offer loans to their members for several purposes like marriages, redemption of old debts, construction, etc. These generally follow easy procedures and offer saving schemes and make credits available to those whose needs remain unmet by formal commercial banking sector. 7th, Chit Fund Company is peculiar to India. It is most prevalent in the southern India. It is a company which collects subscription from specified number of subscribers periodically like monthly and in return distributes the same as the prizes among them by drawing lots. Any other form of chit or kuri is also included in this category. The operation of chit fund companies are governed by the Chit Fund Act of 1982 and administered by the state governments. Their deposit taking activities are regulated by the Reserve Bank. 8th, Residuary Non-Banking Companies, RNBC. It's a company which receives deposits under any scheme by the way of subscription or contributions and does not fall in any of the above categories. Next, we will discuss the role of NBFIs. Like banks and other financial institutions, NBFIs serve as a crucial link between the ultimate saver and the ultimate borrowers. The need for the financial intermediaries arises because savings and investments are done by two different sections of the economy and it is very difficult and costly for them to deal with each other directly. The financial intermediaries intermediate between these surplus units which save and deficit units which are in need of such savings. The intermediaries reduces the transaction cost, reduce the risk of default, bring in the convenience and result in a more efficient utilization of resources in the economy. This is because financial intermediaries are endowed with economies of scale on account of their professional expertise and their ability to spread the risk over a large number of units. The banking financial institutions generally cater to the financial needs of the industry, commerce and agriculture, while NBFCs are generally for transport, trading, acquisition of durable consumer goods, purchase and repair of houses or just for plain consumption. Unlike banks, especially the commercial banks, NBFIs are not subject to stringent control by monetary authorities, so the credit extended by NBFCs may not necessarily be in consonance with national objectives and priorities. Despite this, they help in monetizing the economy and transferring the unproductive financial assets into the productive assets, thereby contributing to the country's economic development. In the recent times, the nature and diversity of financial institutions themselves have become the indicator of economic development of a country. The non-banking financial institutions have important role in first, supplementing the bank credit with a major thrust on semi-urban, rural areas and first-time buyers or users. Most formal financial institutions do not serve the vulnerable rural areas because of perceived high risk, high cost involved in small transaction, perceived low profitability and probable inability to provide the physical collateral required by such institutions. Also, the first-time borrowers and savers resist entering into the formal banking sector for their financial needs. In all such situations, the role of NBFIs comes in. NBFIs keep themselves involved in finding innovative ways to provide financial services to the poor so that they can improve their productive capacity and quality of life. Through nidhis and chit funds, these vulnerable people get to avail the financial services which formal banking sector fails to provide. Second, development of sectors like transport and infrastructure. Banking financial institutions are stringently regulated with provision of priority sector lending applicable on them. In such circumstances, the sectors left out or which are not properly focused by BFIs resort to the services of NBFIs. The fulfillment of credit needs of the transport sector and infrastructure is a prerequisite for the broad-based development of the economy. NBFIs serve the need of these sectors through their specialized functional institutions, thereby promoting overall development. Third, to finance economically weaker section. Most of the poor live in the rural areas, are engaged in agricultural activities with limited access to conventional credit and insurance markets. NBFIs, through their geographically diversified presence, come to the rescue of such economically weaker section in order to bring out equitable development. NBFIs, by providing microfinance to the poor, can help in enabling the poor to smoothen their consumption, manage risk better, gradually build asset, develop micro enterprises, enhance income earning capacity, and generally enjoy an improved quality of life. Improved resource allocation, development of financial markets and system, and ultimately the economic growth and development. Active participation of vulnerable section in benefiting from development opportunities. Fourth, substantial employment generation. NBFIs generate employment opportunities in two ways. Employment is directly generated when more and more financial intermediaries start to operate in the economy along with the expansion of non-banking sector. Also, by providing financial services to people who want to start a new business or for capital formation, they facilitate the generation of employment indirectly when these firms who borrow start new companies and expand their respective businesses by hiring the professionals and other employees. Fifth, huge contribution to the state exchequer. It is well known that money makes money. The growth and expansion of economy and the financial sector supplement and complement each other. When the commercial activities pick up pace due to the presence of NBFIs and their efficient services, these result in huge contribution to the state exchequer. Sixth, broad-based economic development. Financial intermediaries are expected to play a very important role in the development of large-scale industries in India. New forms of credit and new types of financial institutions may increase the volume of capital of firms by facilitating the mobilization of funds. Pension fund is a form of non-bank institutional investor which collects, pools and invests the funds contributed by sponsors and beneficiaries to provide for the future pension entitlements of the beneficiaries. It provides a mean for individuals to accumulate saving over their working life so as to finance their consumption needs in retirement. Pension funds improve the efficiency of the financial system by influencing the structure of securities market. It helps to generate liquidity. Similarly, insurance market activity, both as financial intermediary as well as a provider of risk transfer and indemnification, promotes the growth of the economy by letting the different types of risk to be managed more efficiently by supporting the accumulation of new capital and by mobilizing the domestic savings into the productive investment. The insurance activity contributes to the economic growth by the means of encouraging the financial stability, facilitating trade and commerce, and mobilizing the domestic savings which are to be channeled in the productive investments, and thus fostering more efficient allocation of domestic capital, which helps to reduce or mitigate losses. Insurance market activity may not only contribute to the economic growth by itself, but also through the complementarities with the banking sector and the stock market, that is the other financial intermediaries. Seventh, promoting wealth creation. Bank and non-bank financial institutions play an important role in promoting the savings in the country. Savers need stores of value to safekeep their savings in. These institutions provide a wide range of financial assets as a store of value and make available expert financial services to the savers. Savings done can be used at later date in creating wealth. Therefore, the role of NBFIs as a promoter of wealth creation cannot be doubted. Further, we will understand the regulation and supervision of NBFIs in India. An important issue in the context of financial institutions is their regulation. As their role and importance goes up in the economy, it brings in the need for the proper regulatory and supervisory framework to be placed to restrict their ability to have any adverse effect on the economy. NBFCs are particularly important for facilitating the storage of value and intermediation of risk, and like other financial institutions, they are sensitive to run and herding behavior. If the financial sector does not work smoothly, it can result in high transaction cost, lack of confidence and short-sightedness of the economic actors, thereby bringing instability and inefficiency. For these NBFCs to operate smoothly, certain regulations related to their operation, organization, establishment and working behavior need to be set so that the confidence of participants as well as the operators can be maintained. The financial sector regulation is important. First, to protect the participants against systematic risk. Second, to enhance efficiency. And third, to achieve consumer protection and social objectives. The regulatory framework for NBFCs has been in existence since 1963 under the provision of Chapter 3B of the Reserve Bank of India Act and the directions issued. The regulation of the deposit acceptance activities of NBFCs was initiated in 1960 with an understanding to safeguard depositors' interest and to ensure that the NBFCs function on healthy lines. Since then, looking at their enlarged scale of operations, there have been various committees set up for framing, amending and suggesting appropriate regulatory provisions for NBFCs. Before 1997, RBI supervision of NBFCs was limited to the prescription of prudential norms and thus the structure of NBFCs assets. There were no requirement regarding minimum capital, amount and term structure of deposits and interest rates on deposits and loans. While the banking sector was heavily regulated, NBFCs enjoyed substantial regulatory comparative advantage for several bank type activities, among which lending and deposits taking are most notable. Between 1981 and 1996, as the number of NBFCs grew more than sevenfold and the share of non-bank deposits increased, this prompted RBI to take action. In 1997, NBFCs were imposed with regulatory standards of maintaining minimum NOF, that is net owned funds, and a maximum deposits to NOF ratio. But these were partially implemented because many small NBFIs like Nidhis as well as RNBCs were exempt from maximum deposits to NOF ratios and partly from interest rate ceilings. The regulatory framework for NBFIs in India is a mixture of institutional and functional. Under the former, each financial institution has its own regulatory agency, while in the latter, there are separate agencies for each function of an NBFI. In India, for instance, RBI regulates ELs, HPs, investment companies, LCs and RNBCs. Similarly, HFCs, ICs, SPCs and MBCs report to the National Housing Bank, the Insurance Regulation and Development Agency and the Stock Exchange Board of India respectively. All these are the instances of the institutional regulation. Functional regulation is reflected in the fact that Nidhis report to the Department of Company Affairs and chit fund companies report to the State Registrar of chit funds for their general operations as well as to the RBI for their deposit taking activity. Due to the substantial deviation from the regulatory standards, inefficiencies continues to be common feature of NBFC sector. While the regulatory measures implemented over the last decade are steps into the right direction, regulators still have to go long way to create an environment of perfect regulation of NBFIs without adversely affecting their operational efficiency. Let us now summarize what we have learned in this module. First, NBFIs are those institutions which do not have a full banking license and supplement the financial services along with the banking financial institutions. Second, they have a key role in monetizing the economy and transferring the unproductive financial assets into the productive assets, thereby contributing to the country's economic development. Third, since 1997, extensive regulatory framework has been put in place to safeguard the depositors' interest and control the economic operations of NBFIs.